Most people imagine financial collapse as sudden and explosive, like a dramatic movie scene where everything shatters at once. But real crises almost never look like that. Instead, they grow slowly, quietly, almost invisibly, for years. And the terrifying part, by the time the public notices, the collapse is already in motion. The surface looks stable, yet underneath, pressure builds until one small shock finally snaps the entire financial system in an instant. It's like watching a dam, no cracks on the outside, but massive tension building behind it. And if you listened closely during those calm years, you would notice tiny signs, barely perceptible shifts in credit markets, subtle distortions in lending behavior, quiet movements in asset prices. These signals don't scream, they whisper, and most people aren't trained to hear them. What kind of tension? Debt, leverage, liquidity, dependence, asset bubbles, mispriced risk. Think of these as 5 silent explosives wired beneath the economy. Individually, they're dangerous. Together, they're catastrophic. All they need is timing and a spark. And sparks don't always look like explosions. Sometimes they're small, a missed payment, a sudden downgrade, a quiet policy change, or a single institution losing confidence at exactly the wrong moment. If even one of these shifts at the wrong moment, the system moves from stable to chaotic fast. Yet in a fragile system, even a tiny spark can travel like lightning. Crashes rarely come from nowhere. They are the final stage of long-ignored warning signs, hidden risks, and structural weaknesses that have been accumulating for years. Look at 2008. Look at the Asian crisis. Look at Argentina, Greece, Turkey, Iceland. Every one of them looked fine, until the moment they weren't. There were always warnings. People simply refused to see them, because seeing danger requires discomfort. It forces people to question growth, to slow down celebrations, to admit that maybe the boom isn't sustainable. And humans, by nature, prefer the comfort of believing that good times last forever. The myth of the unexpected crash comforts people, but data shows most collapses follow recognizable patterns visible years earlier. Here's the uncomfortable truth. Markets almost always whisper before they scream. Credit accelerates. Asset prices disconnect from reality. Government deficits expand. Short-term debt piles up. Risk-taking becomes normalized. And everyone convinces themselves, this time is different. It never is. Optimism is addictive. People don't ignore danger because they're stupid. They ignore it because comfort feels better than caution. Prosperity makes everyone believe they're safer than they actually are. Investors begin to mistake luck for skill. Policymakers begin to mistake temporary stability for permanent resilience. And everyday households begin to believe that rising prices are normal, that debt will always be easy to refinance, and that the system is far stronger than it really is.
Long periods of stability create the conditions that later make the system dangerously unstable.
Economist Hyman Minsky explained how long periods of stability create the conditions that later make the system dangerously unstable. During good times, both investors and institutions begin to believe nothing can go wrong. Risk management weakens, lending standards drop, speculation grows, debt multiplies. It's not chaos that causes collapse, it's calm. Calm creates the illusion that everything is safe. That illusion is where the danger begins. Stability breeds confidence. Confidence breeds risk-taking. And risk-taking gradually erodes the very stability that made people confident in the first place. It's a cycle, invisible while it's happening, obvious only in hindsight. Trigger 1 is leverage. When households, corporations, governments, and banks build up too much debt, the entire system becomes fragile. Debt turns slow mistakes into fast disasters. It magnifies every shock. A small rate hike suddenly becomes a crisis. A minor recession becomes a catastrophe. Even tiny interest rate increases or small drops in asset prices turn catastrophic when debt levels are stretched far beyond reality. Most systems can survive a 5% drop in housing prices, but if homeowners borrowed 95% of the value, they are wiped out instantly. Leverage becomes dry fuel spread across the economy. Any unexpected spark can ignite the entire financial structure instantly. The problem isn't the spark. The problem is the fuel. And the most dangerous part, fuel accumulates quietly. Debt doesn't announce itself. It grows in spreadsheets, in loan books, in credit markets, far away from public attention. By the time society realizes leverage is out of control, the system is already too fragile to absorb shock. Picture a forest floor covered in dry leaves. A single match doesn't just burn, it spreads. That's leverage, a multiplier of destruction. Trigger 2 is liquidity mismatch. Institutions borrow short-term but lend long-term, leaving them dangerously exposed to sudden funding freezes. This is how bank runs start. But modern runs don't look like people lining up outside a branch. They happen digitally, instantly, in milliseconds. As long as confidence holds, this system works. But once fear appears, cash disappears instantly and banks collapse overnight. Depositors stay calm. Short-term lenders roll over loans. Money markets keep flowing. But once fear appears, cash disappears instantly and banks collapse overnight. Even banks that looked perfectly healthy on paper. This is why liquidity problems quickly become solvency problems. Not because the bank was bad, but because the timing was fatal. In the age of digital finance, confidence doesn't erode slowly. It evaporates. One algorithm changes its risk flag. One lender pulls a credit line. One fund halts redemptions. And suddenly, liquidity that seemed abundant becomes impossible to find. Trigger 3 is the Minsky moment, when years of optimism flip into panic and speculative borrowers can no longer refinance their debts. This is the tipping point, the moment when the music stops. Defaults rise, collateral values fall, and margin calls spread, turning a mild slowdown into a violent market freefall. This tipping point transforms confidence into fear, and once that shift happens, collapse feeds on itself with brutal precision. Prices fall, gives lenders panic, gives collateral weakens, gives more margin calls, gives more selling, gives deeper collapse. It is a financial chain reaction. Once it begins, stopping it is almost impossible. The Minsky moment is the exact second when belief dies. Not gradually, not politely, but violently. Markets stop asking, how high can this go? And start asking, how much can I lose? When that switch flips, no policy, no optimism, no speech can stop the acceleration. Trigger 4 is contagion, the hidden pathways linking banks, funds, and global markets that let failures spread instantly. This is where a single spark becomes a global fire in highly interconnected systems. One institution's shock becomes everyone's problem, amplified by leverage and shared exposures. Shadow banks and non-bank lenders now deepen this danger. They hold massive portfolios. They borrow short-term. They are barely regulated. A failure anywhere becomes a failure everywhere. And the danger isn't only financial companies. Countries are linked. Currencies are linked. Bond markets are linked. Derivatives tie trillions of dollars of obligations together into a web so dense that if one part snaps, the tension shifts violently to the rest. Trigger 5 is complacency. Policymakers ignore early warning signs because booms feel good, and no one wants to slow the party. During booms, rates stay low, borrowing accelerates, asset prices soar, and vulnerabilities grow until the system becomes quietly unstable. Everyone wants the growth, but nobody wants the responsibility. By the time action is taken, fragility is already baked in, and even small policy mistakes can trigger a widespread financial crisis. History proves this again and again. Not acting early is far more expensive than acting decisively. Ordinary people can watch for signals. Debt rising faster than income. Housing and stocks rising far beyond fundamentals. Governments running deficits during good years. Banks and funds reaching for risky yields. These are not random. They are early warnings. But complacency blinds nations. It convinces people and leaders that stability is guaranteed, that risk is contained, that this time really is different. And it's always at that moment, the peak of confidence, when fragility is highest. When banks, funds, and households all reach for risk at the same time, it signals a system stretched far beyond safety. Financial collapse is never about one bad day. It is the release of pressure built quietly over many years of ignored warnings. Once confidence breaks, even slightly, the system unravels quickly, revealing the hidden fragility beneath the surface. The real question isn't whether another collapse will happen, but which silent triggers are building right now, and how close we are. Maybe the next crisis won't look like 2008. Maybe it won't start with housing, or Wall Street, or a failing bank. Maybe it's already forming quietly in places nobody is paying attention to. That's how collapses begin. Not with noise, but with silence. Because collapses don't begin with noise, and the silence is always easy to miss, until it's too late.